Leaving an old 401k behind when you change jobs or retire feels like the safe default. It stays out of sight and seemingly out of mind. But parking those funds in a market-exposed account right as you approach retirement carries severe mathematical consequences. It exposes you to what financial planners call sequence of returns risk. If a market crash hits exactly as you start taking your retirement withdrawals, you are selling off assets at plummeting prices. Because of the math of compounding, drawing down an actively shrinking portfolio severely damages the account's ability to generate income. Hoping the stock market will only post positive returns during your retirement years is not a viable strategy. Once you reach the distribution phase of your life, protecting your principal from market downturns becomes a mathematical priority. This chart shows how a fixed index annuity solves this. It captures market upside while enforcing a strict safety net, a 0% floor. If the market drops 20%, your interest credit is zero. Your principal and past gains remain intact. Yet, despite that mathematical advantage, many people freeze. They hear industry myths suggesting annuities are impossibly complex, weighed down by hidden fees, and lock up your money indefinitely. And then there is the final hurdle, the fear that touching an old 401k will accidentally trigger a massive IRS tax penalty. To make a confident decision about your retirement capital, we need to systematically debunk those three product myths and look at the exact IRS rules governing the transfer. Insurance companies issue FIAs as fixed insurance contracts designed for capital preservation rather than as securities held directly in the stock market. The growth mechanism is actually quite mechanical. When you deposit your premium, the insurance company places the vast majority of it into a highly conservative bond portfolio. They then take a tiny sliver, usually just the anticipated interest from those bonds, and use it to buy call options on a stock market index like the S&P 500. Those options generate your return if the market goes up, but to provide that ironclad 0% floor, the insurance company has to limit your upside. They apply strict caps or participation rates, meaning you capture a specific stated portion of the market's gains. This directly addresses the fee myth. Base FIAs typically carry zero explicit annual management fees. The insurance company's operating costs and profits are already factored into the math of those caps and participation rates. The major exception occurs if you choose to attach an optional income rider to your contract. These riders guarantee a lifetime paycheck, regardless of how long you live, and they require a specific annual fee deducted from your account balance. By looking at the actual mechanics, the FIA reveals itself as a transparent preservation tool, completely distinct from a volatile, fee-heavy securities portfolio. The final myth is that an annuity locks your money in a vault, making it totally inaccessible for a decade. Most standard FIAs include an annual penalty-free withdrawal allowance. You can typically access up to 10% of your total account value each year without triggering any contract penalties. However, FIAs are designed as long-term contracts. If you withdraw more than that 10% allowance during the first few years of the contract, known as the surrender period, you will incur steep surrender charges. Because of these timelines, a strict rule of retirement planning applies. Never commit your entire liquid net worth into an annuity. You must maintain a separate, accessible cash reserve for unexpected emergencies. Managing liquidity in an FIA requires matching your withdrawal timeline to the contract schedule and ensuring your capital aligns with your actual needs in retirement. Selecting the right contract is only the first step. Moving the funds into it requires following a strict IRS roadmap to avoid unnecessary taxation. The most dangerous scenario is an indirect rollover. If your old employer cuts the check directly to you, the IRS forces the plan administrator to withhold a mandatory 20% of your money for taxes right off the top. That triggers a stressful 60-day ticking clock. You have exactly 60 days to deposit the full original balance into your new account. To avoid penalties, you must replace that withheld 20% entirely out of your own pocket. If you miss the deadline, the entire amount becomes fully taxable income. Fortunately, you can avoid this trap entirely by utilizing a direct trustee-to-trustee transfer. The order of operations is crucial. First, work with a professional to open your new FIA account. Obtain the precise receiving routing instructions from the insurance company. Then, instruct your 401k provider to wire the funds directly to the new custodian. Because the funds move straight from institution to institution, the money never touches your personal bank account. The IRS processes this as a completely non-taxable, seamless rollover. Once the paperwork clears, your financial landscape shifts. Your vulnerable 401k has successfully transitioned into a protected, tax-deferred, fixed index annuity. With the transfer complete, the principal is insulated from the volatility of a standard brokerage account. A 0% floor means that even during years of market loss, the account value remains stable, providing a predictable foundation for future withdrawals. This process effectively removes market risk from a specific portion of your savings while maintaining the tax-deferred status of the original 401k. Track down your old employer plan statements and schedule a session with a licensed fiduciary. They can run the math to see exactly how an FIA aligns with your timeline. Securing a dormant 401k protects the capital you spent a lifetime building. It locks in your control over your own financial legacy.